Well, hello, this is Jeremy North with your educational and economic update for April of 2022. On this month's video, I will discuss major headlines that influence markets in March and economic and market events that we are looking at to influence April returns. Please stay tuned at the end of the video for the always exciting required disclosure statement. Well, it has been a challenging first quarter of 2022 with the onset of higher inflation and the prospect of higher interest rates. Markets fell hard in January and February, but bounced back for a modest recovery in March. While the S&P went into a correction mode down over 11%, the NASDAQ even fell further as it got very close to entering bear market territory as it has dropped 19% from its high. NASDAQ has recovered around half of its drop and is currently down just under 10%. At negative 9.6%, while the S&P recovered over half of its drop and is down just a bit under 5% year to date. March returns are pretty impressive given the headwinds that we're currently seeing, such as the Russian invasion in Ukraine, rising interest rates, and of course, inflation. This is a big positive for the state of the market. Well, wages rose 5.6% year over year this March, and the Fed's favorite inflation measure is the index of all average increases in prices for all domestic personal consumption. Well, that index rose 5.4 in February. Manufacturing PMI fell to its lowest level since September 2020 in March, as new orders were lower and higher prices hurt purchasing power. We all have seen this firsthand when we fill up our gas tanks, and it costs probably around a third more than it did just a few months ago. Food prices have also increased substantially, as we all have seen at the grocery market. The higher fuel and food prices have affected GDP and consumer confidence, as well as the increase in mortgage rates. For the first time in a long while, home sales and new mortgages have dropped. Less spending in the economy, along with rising interest rates, could jumpstart a recession. Due to this inflation, which was a problem even before the Russian invasion, the markets began pricing in interest rate hikes. The problem is that experts don't know if the Fed's expected aggressive rate hike action will be enough to slow or halt inflation, and what those hikes will ultimately do to the stock market. Another concern for the market is that real interest rates are negative. By this, what I mean is that interest rates minus inflation is a negative number. Currently, this is having the effect of propping up the stock market, as those who may normally look to buy bond investments are finding that their real returns are negative. This has investors looking more at stocks as there is more potential for positive returns. To confuse matters further, if the Fed is successful in curbing inflation, real returns will turn positive, and that in effect could hurt the stock market. So as usual, navigating the economy and the market is a tricky proposition. All these competing factors are creating an outlook that the market will remain volatile until we have a better idea of how the Fed's moves affect the economy, as well as how the conflict in Ukraine lasts. As usual, we urge you to be prepared for volatility, continued volatility. We're diligently assessing the economic and political implications for your portfolio. Should you have any concerns or questions or would like to discuss your personal situation, as always, give us a call or email. With all that being said, here is the required disclosure I'm going to read. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult with your financial professional before making any investment decision. Investment and investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks again, Jeremy North signing off for the month of April. I wish you a very happy start of spring, hoping for warmer weather, at least in my area, and go Cards. Take care. Bye.